Good day from ADK Wealth Advisory Group's lobby in St. Louis office. Thank you for joining us. Today's purpose really is to look back at 2018 and then look forward at 2019 and beyond. If you really sum it up, our third quarter video, if you haven't already watched it, I would watch that after you turn this off. Really, this is just an extension of that because nothing has happened or is happening that would conflict with that. So if I were going to summarize going backwards to 2018 and looking forward to 19, let's start with the economy. There was an article in the December 1st Wall Street Journal. Title was Global Growth Cools, Leaving Scars of 2008 Unhealed. And they quote the Organization for Economic Cooperation and Development, which is a think tank that the largest developed world economies use. And they talked about the expectation going backwards that they believe that the GDP for the global economy for 18 will finish around 3.7. I think it might be a touch lower than that, but still exceeded most people's expectations if you were to have this conversation before 18 started. And then they're believing that the economy will cool slightly down to about 3.5 globally. I think that's a little generous. If I were going to be estimating it, I'd say low threes, high twos, and if someone made me bet, I would bet below 3 as a global growth, which is still a pretty good global growth number. If I take a look at equities and you go back, 2018 really has been super choppy. I'll give you a for example. In 2017, we had one period where the markets went down 3%, and that wasn't even in a day. That was just like peak to trough, a little bit more than 3. In this calendar year, we've already had several one-day 3% drops, which is indicative of volatility created by uncertainty. So if I take a look at things that are headwind oriented, whether or not it's trade wars that I believe are really trade fights, as you've heard me talk about, issues around Facebook, a whole variety and slew of things that created a degree of uncertainty that created market choppiness. If you take a look at the tailwinds, the things that have been really favorable, one of those is earnings growth. The S&P 500 has had 3 quarters reported, all of which were over 20% growth. In my 30 years doing that, I can tell you that there's very, very few times that occurs. But again, while that's really positive news, the negative news around the uncertainty from trade wars, rising interest rates, et cetera, offsets that. So as we looked at 2018 forecast, it looks like we're going to come under what we had forecasted. And when I take a look at international, that's really where we've seen the negative returns, whether it's developed world or emerging markets. Emerging markets have really been beat up. Europe's been beat up. If we take a look at things that leave the equity markets and go to, say, fixed income, interesting in that at the beginning of the year, the U.S. 10-year Treasury stood at about 2.9%, and you saw it steadily going up. In the beginning of the third quarter, you see about 3.2 to 3.4%, and then just recently it slid right back almost to the beginning place of the year. So our expectations are that you're going to see continued interest rate increases that are choppy, that it goes up, comes back down, but the overall trend is up. If I were going to sum up our thoughts around bonds, it would be very simple. It's that European and Japanese rates are ultra low. Like right now, the 10-year Treasury on the German Bundesband is around 0.25%. If you look at Japan's 10-year, it's less than 0.1%. So that's really causing the yield curve to stay low, but the Federal Reserve is raising rates, which is causing it to go up. So there's this battle back and forth. And the big headline concern is around the concerns with an inverted yield curve. What is an inverted yield curve? It just basically means that rates at the short end are higher than rates at the long end of it. And 9 out of the last 10 recessions had an inverted yield curve before the recession hit, and 5 out of the last 5. The interesting footnote to that, though, is that once a yield curve actually inverts, the average recession is 19 months later. And just to be clear, we have not had an inverted yield curve yet. There's a lot of fears about it, but so far it has not occurred. Interest rates on bonds will stay low even though they'll be rising. We expect the returns on them to be better than cash, but not by a lot. Kind of the big story that you really don't hear much about is oil. Oil started the year continuing to creep up, hit its peak at about $74 a barrel, and then just sort of fell back into, as of today, it's around $53 a barrel. That's a really good tailwind for the global economy because energy prices comes down. It's a headwind for the S&P 500 earnings because 11% of the companies that report are energy oriented. So in conclusion, our expectations are that we're in the ninth inning, if you want to use a baseball metaphor, if you want to use a football metaphor, we're in the fourth quarter of the economic expansion globally. We do not see a recession in 2019. Again, the window that we would see would be somewhere mid-2020 to the end of 2021. And our expectations for global growth would be high 2%. If we take a look at equities, we would expect middle to high single-digit returns on U.S. equities, not very favorable on European equities. If we take a look at the emerging markets equities, that's where I'm the most bullish because A, it's been hit the hardest over the trade discussions, and it's also one that I can't really put a number on because if stuff goes favorable with the trade discussions, I could see like a 20% return. If things go neutral to negative, I could see just continued choppiness until that gets settled. So hard to really say, but when I look at a 3 and 5 year on the emerging markets, very favorable. When I take a look at bonds, again, just to reiterate, our expectations are very low single digits beating cash. And in wrapping things up, I'd like to say thank you very much for your business. I'd also like to celebrate with you as this has not been the best financial markets to celebrate. It certainly has been a great year for the Davis family. We've finished our move in Nashville to where we literally bought a house in September and almost out of boxes as I speak to you in December. But more importantly is all the health news that I've continued to get is very favorable. So all the exercise patterns and all that are back to normal. So thank you very much. Signing off from St. Louis.